Good day, guys. Today I have a little cold, so I just hope that it doesn't interrupt the recording for today's teaching. So today we're going to be talking about market orders and trading sessions. Forex orders. Basically, the term order refers to how you will enter or exit a trade. So order just has to do with the order you're giving your trading platform. It's either you buy or you sell. So now there are two classes of orders. We have the market order and then we have the pending order. In the market order are orders that are instantly executed against a price that your broker has provided. It is an order to buy or sell at the best price available. So it is instant execution. So it's called market order. The other class of order is pending order. Pending order is an order to be executed at a later time at the price you specify. So now let's say Euro USD is trading at 1.2 at this price, 1.2342. Now, if you give a market order, either you buy or you sell, what happens is that your order is executed instantly at this price. But let's say you don't like this price and you want to buy it in a different price, the order you have to set will be called a pending order. So once price gets to your desired price, what happens is that your order is executed. I hope you understand. So now there are four types of pending order. We have buy limit, buy stop, sell limit, and sell stop. So we'll be looking at this type of orders individually. All right, limit orders. So like I explained before, we have buy limits and sell limits. A limit order is an order placed to either buy below the market or sell above the market at a certain price. Now, I told you this is an example of a pending order. And the two types are under this limit order are buy and sell. The other two types are buy stop and sell stop. So we're talking about the limit order, which is buy limit and sell limit. So this order to buy or sell is an order given once price reaches the limit price. Okay, let me explain. Let's assume that price is here. This is where price is. And then you want to buy. If you are buying, you have to buy low and sell high. So you have to buy when the price is cheap. So you will set a limit buy order below the current price, because this is the price here. So you want to set your buy limit here. So once price goes down and touches the limit, you are expecting it to rise in value, because the price it is currently, this blue dot we are seeing, is too expensive for you to buy. So you want it to go down to a cheaper price that you can buy, hoping that it goes up. Do we understand? So it's very simple. So buy limit is an order to buy below the current price. It has to be below the current price because you want to buy low. So it's a limit at which you can allow price to go down for you to buy. Then the reverse is the same for the sell limit. We can see this blue dot here. This is the current price. So you want price to go up because you want to sell high. You want to sell when the price is expensive. You can't sell, if you sell at this price, it's cheap. So let's say you want to sell your iPhone. You will want to sell it at an expensive price. You don't want to sell it cheap. You want to sell it when it is expensive. So the same with currency. You want the currency price to go high. So you are setting a limit at which you can allow price to go for higher. So once it goes high, you are expecting that as it touches your limit, your order is triggered and executed, hoping for price to fall. Do we understand? Mind you, it doesn't mean that if you place a sell limit or a buy limit, once price gets there, it goes the other way. It could actually keep going down and you may lose the trade. So it's just a way of entering a pending order, an order that is not executed instantly in hopes of getting a better price. So there's a possibility that if you set a buy limit below this current price here, price might not get there. Price might just go down a little, or price may just keep on going up and your order will not be triggered. So the only time your order is executed or triggered is when it touches or goes through that limit order, either buy or sell. It has to touch it. It has to go through it, whatever. Just touch that price has to actually get to that point first before the order is triggered. So it's called a pending order. It's not executed immediately. So once price reaches the limit price, the order is triggered and executed at that price or better. Okay, so let's move on. So now we're going to talk about the second types, which is the buy stop and sell stop. So I classify it as stop orders. So a stop order stops an order from executing until price reaches a stop price. So now it's like you setting an order whereby it is not executed until price gets to your desired price before that order will be executed. So let's look at this image here. This is the current price, this blue dot. And then you put a buy stop above it. It has to be above it, meaning that it stops your execution of buying until price gets to this point. Remember, buy limit, the order is placed below the current price if you are buying. But for a buy stop, all it just means is that once price crosses above or gets to the point at which you would like to buy, the order should be executed. So the difference is just that for a buy stop, the order is placed above the current price. But for a buy limit, the order is placed below the current price. So limit is like how far you can expect price to go down before your order could be executed if it is a buy limit. But buy stops is it stops your order until it gets to a certain price point before the order is executed. So the reverse is the same for a sell stop. You place the sell stop below the current market price. So this blue dot represents the current market price. And then this red line we can see represents the sell stop order. So it stops your order from being executed until price gets to that. So this is just one way people also use to enter the market. They use it as a confirmation. So let's say this is a high, price retrace, is a higher high, price retrace, is a higher high, price retrace. What happens is that they tend to place a buy stop here above. What does that mean? If price continues going high, their order will be triggered. So if price continues higher like this, they'll enter a buy trade. Do you understand? So let's say if the market doesn't get to this point and it fails, though it has a way of protecting them from entering the wrong trade. So the buy stop and sell stop are usually used for confirmation in entering trades. But for a sales or buy limit, it is used for, let me just draw an image here so that we see it. Now, this is price going up, coming down, retracing, a higher high, a higher low. So now, once prices are this high, they will wait for price to go below the current market price. So let's say at this point here, they will place their buy limit. Now, once price goes down and triggers this order, they enter a buy trade with hopes that price continues in this trend for them to make profits. I'm sure we understand. So if you don't understand, you can just come back to this lecture or the notes to get a better understanding. A stop entry order is an order placed to buy above the market or sell below the market at a certain price. Very simple. So let's move on. So now, there's another type of order that we should also understand. Many people call it stop loss, but it's actually a stop order. Now, a stop loss order is an order to cut out if the market price reaches a specified price, which may represent a loss of profit. So people call this stop loss. Now, this is an order which you place in the market to come out of a trade. So let me give an image here for us to understand. Now this is current market price, and then we want to buy. So let's say we enter with a market order that is an instant execution. So let's say you buy. Now, if you buy, you're expecting that price moves up. But then in order to protect your balance, in order to protect your capital, you need to put a stop loss order. A stop loss order is an order that limits the amount of loss you are willing to take, because there's a high chance that price will not go high but go down. So you want to set a stop order, a stop loss order, where if price gets to, it takes you out of the trade. You are taken out of the trade immediately. Do you understand? So I'll say it again. So I'll use another example for a sell. So now this is current market price, and then you want to sell. You will place your stop loss above the current market price. And where you are placing this stop loss, you're placing it where you can't afford to be in a trade if price gets beyond that price. Do we understand? So it is a price at which you are willing to leave a trade, to end a trade if price goes against you. A stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. So it is an order to take you out of a trade when price is going against you. So if you are buying and price is falling, it's going down, you don't want it to continue going, because it continue going down and you are still in the trade, you will lose all your money. So in order to limit the amount of losses you can take, you place a stop loss order. So if you're in a long position, it is called a stop order. If you're in a short position, it is called a buy stop order. Do you understand? So, like I said in one of our lectures, I said if you buy, to come out of the trade, you have to sell. If you sell, to come out of the trade, you have to buy. So that stop loss order is doing the reverse of what you are doing in the market. That's why this statement says if you're in a long position, that is, if you are buying, it becomes sell stop because you are selling. So it is similar to the previous type of order that we explained before. Look at it here. Buy stop and sell stop. So now, if, let's say, let me draw it here. So if you are selling now, this is a buy stop, right? This order here, this blue line is a buy stop. So if you are selling, you don't want price to go up and continue going up, because if you are still in the trade, you will lose your money. So you need to set a buy stop. So at this point here, what happens? You buy. So if you are buying while you're in a selling trade, it means you are coming out of the trade. Now, the same thing goes for selling. Now, the sell stop will be what will protect a buy or a long position. So if you are buying, let's say this is the current price, and then let me clean this here so that we can. If you are buying, you don't want price to keep going down and continue going down while you're still in the trade. You want to put a sell stop to stop the trade. So if you are entering, if the sell stop is triggered while you are in a buy position or a long position, what happens? You are coming out. We understand. This is very simple. Okay, so now let's move forward. Now there's something called trailing stop. Trailing stop is very simple. It's an automatic order that moves as the market price moves, following a specific distance. So a trailing stop is as if you're in a buy position, as the price continues to rise in value, your sell stop order or your stop loss order will also continue to rise with it. So you can see the gap should be between 20 pips, 30 pips, or you could use percentage. So it's just a way you can set it, or you can manually move it. So now let's say price is moving like this. You don't want to lose out in profit. Price is going higher high, making higher highs, higher highs, higher highs, higher highs. So it's possible that your sell stop was here before. So once it moves, create this down movement, this retracement that moves again. You want to put your sell stop here. Then once you retrace, like you keep moving with it manually, or you can set it. There's a way you can set it to with your trading platform whereby it will move as price moves, so that in case price retrace, you don't want to be in a trade where it moves up but then moves down. After this move, you're in a huge amount of profit. After moving this high amount, it then comes down and takes you out. So the money you make is never yours until you close the trade. It's very simple. So you can be in a trade where you are making $200, $300, $500, $1,000. It is not actually yours yet until you close the trade. So hope we get that. No, there are also weird types of forex, so I just named it weird because they are not common, but just so that we know them. So number one is the good till cancel. What does it mean? A good till cancel remains active in the market until you decide to cancel it, just as the name says. Your broker will not cancel the order at any time. Therefore, it is your responsibility to remember that you have the order scheduled. So let's say you place a buy limit now. Why are you placing a buy limit? You are hoping that price will come down to a cheaper price. So let's say price is moves like this. So let me use a different color. So now let's say price moves high and then it retraces, price moves high. So you now place a buy limit here. So you're hoping that price will come down and then trigger your entry. But let's say price continues to move up and your buy limit is not triggered or executed. So this go to cancel. There's a place you see, don't worry, I'll show you all in the trading platform. We're not in this lecture, where you see good to cancel or good for the day. Now, price will continue to go up, but this limit will still remain. So there is a high chance that price can start to retrace and then triggers your buy limit. And once your buy limit is triggered, it might continue to go down, and which may end in a loss. So it is very important that you understand what type of order you are placing. If it is good to cancel, means you have to come and cancel this order because price can still actually reverse down to this buy limit which you placed and then execute your trade, and you will be in a losing trade, or possibly it might actually trigger it and then go. So you just know that. So you just know what type of order you are placing the market and avoid taking risks. Then the second one is good for the day. A good for the day order remains active in the market until the end of the trading day. So this one will close automatically for you when the day ends. So, and it ends, the trading day ends 5 p.m. Eastern time. That is the New York time. So they have a common name. They are called time in force orders. So in conclusion, buy stops is created to open a long position at a price higher than the current price. So you can go back to the previous slide to look at the image. So you want to buy it higher than the higher. So it's usually used for a confirmation. It is used by breakout traders. Let me explain what breakout traders do. Let's say the market is ranging. This is a ranging market. So there's a high chance that once price break out from this range, it will continue going higher. So people place their buy stops here. So once price hits this high, they expect it to go higher. Then the reverse is for the sell stop. So let's say price is ranging in a range. So once price breaks out, they believe that price will continue to go lower. So they place their sell stops here. Then now this buy limit is to open a long position at the price lower than the current price. So it's always lower. They are expecting price to come down. Let's say when it is cheap before you buy. Why for a sell limit? They are waiting for price to become expensive. Not to sell when it's expensive. So they place it above the current price. Now, we're going to talk about trading sessions. This actually should be very interesting and is very important also for risks. Now, listen, the Forex market is open 24 hours a day. Now, it's open every day from Monday to Friday. It's not open on Saturdays and Sundays. But that doesn't mean it's always active the entire day. So just because the market is open 24 hours does not mean it's active all the time. So you should be aware of that. You can make money trading when the market moves up, and you can make money when the market moves down. But you will have a difficult time trying to make money when the market doesn't move at all. So we want liquidity in the market. Liquidity is when there are huge amount or high volume of orders going on or taking place in the market. And this will make the market move. So if the market is not moving, you can't make money. So markets at the current price, and then it moves a little, it comes down, moves a little, comes down, or goes down. So once it's not moving, you can't make any money. You need liquidity. You need an influx of traders trading that market. So they don't trade the market all the time. There's a specific time that these traders come into the market. There's a specific time that there's high liquidity, and we should be aware of that so that we don't enter the market anytime to take trades. So now, you should also know that the Forex market observes two public holidays. So I said the market trades 24 hours every day, except Sundays and Saturdays. There are only 2 days of the year that markets also do not trade. And those days are the Christmas and the New Year, 25th December and 1st January. So I just want to. So if you go to your chart and you look for these dates, you see that there's no record of trading in these days, 25th December, 1st January. All right, so what are those trading sessions? The Forex market can be broken down into 4 major trading sessions. Number 1 is the Sydney session. Number 2 is the Tokyo, which is also called or popularly referred to as the Asian session. The 3rd is London session, and number 4, we have the New York session. So these 3 are actually the major ones I'm going to talk about today. So this is a table showing an overview of all the trading sessions in the local time, Eastern time, the coordinated universal time, and then GMT, that's Nigerian time +1. So this local time just shows the time in that place. Then this is the start time, this is the USA time. This is the time we'll actually be working with for this mentorship. Very important as we begin to go into analysis, technical analysis and trading. Then this is the universal time, and then this is Nigerian time. So we see the Sydney open and close, Tokyo open and close, like that, on London and then New York. So I said here, actual open and close times are based on local business hours, with most business hours starting somewhere between 7 to 9 a.m. local time. So, in Nigeria, this is the time banks also open. I think 8 or 9 said this is when the bank opened. So when the bank opened, transaction begins. And when transaction begins, when there's a trade between buyers and sellers, it affects the upward and downward movement of price. So this is the time you should go into the market to take trades. So you can see them here stated here specifically. Then I'm not going to talk about is trade overlap. So trade overlap, we can see here that Tokyo is also known as the Asian trading time. And we're going to be talking about these 3 sessions majorly for this class. So we can see Tokyo opens the Eastern time, 7 p.m. to 4 a.m. But we can see an overlap here between 2 a.m. and 4 a.m. There's an overlap here. And this overlap, we'll discuss it. We'll see how significant it is. There's also an overlap between London and the New York. You can see 2 a.m. to 11 a.m. So 8 a.m. Between 8 a.m. and 5. No, 8 a.m. and 11 a.m. There's an overlap. Tokyo, the Tokyo session. The opening of Tokyo session at 12 a.m. GMT marks the start of currency trading in Asia. Japan is the 3rd largest forex trading center in the world, since the yen is the 3rd most traded currency, partaking in 16.8% of all forex transactions. Overall, 20% of all forex trading volume take place during the Asian session. So there is a huge liquidity in this session, in this time window. 20% of all forex trading takes place in this session. So that what are the key points? The main market participants during the Tokyo session are commercial companies, exports, and central banks. Now, why these sessions are actually very important is because this is the time they wake up. We have different time around the world, like 2 a.m. in Nigeria, from 2 a.m. in USA. So we don't experience 2 a.m. at the same time. We're experiencing different time in different places. So this time is when banks open. And banks actually control a huge amount of currency transfer, currency buying and selling. And the law of supply and demand. When there's high demand, the price changes, especially when there's limited supply. So when banks open, when currencies are being exchanged between countries because of exporting, and all these things happen during this time window. By this time, some people are still sleeping in other countries. But that's why all forex transaction is not 100% here. It's just 20% based on the currencies that are involved in forex trading. Now, liquidity can sometimes be very thin. This session just have 20% of all forex trading volume. So sometimes, not all the time, it can be very thin. It might not move that much. But this session actually is a good session for trading the forex market. But now we should know that you can't just trade all pairs during this session. There are specific pairs you can trade. It is more likely that you will see stronger moves in Asian Pacific currency, like the odd USD and the New Zealand USD, as opposed to the non-specific. So this just means that the countries that are in this continent, the Asian continent, that wakes up at this time, that begins economic transaction at this time, are the currencies that are best to be traded in this time window. And they just listed them. We have the Australian USD, we have the New Zealand USD. So trading British pound, the European pairs like Euro USD and all these pairs will not be advisable because they really don't move this period. Okay, so let's see further. Most of the action takes place early in the session when more economic data is released. So there's also a release of news. So this also affects the liquidity. Market news affect liquidity during trading sessions. Moves in Tokyo session could set the tone of the rest of the day. Traders in the later session will look at what happened during the Tokyo session to help organize and evaluate what strategies to take in. So the Tokyo session, or also known as the Asian session, can also give a picture of how the entire day we trade. So I'm going to be releasing a strategy using the Asian session in our subsequent lecture to come. But for now, we should just understand the time window. So you can use the Asian session to determine how the day will look like. Because you can use it for a strategy, because sometimes the Asian session ranges, especially in the European pairs and not in Asian pairs, it ranges. So if it ranges, you're expecting that price would move. Do you understand? So price always tends to move from a range. It's good that you see price range, because after a range, what happens? There's an expansion. So people can use it as a strategy. Now, typically, after big moves in trading New York session, you may see consolidation during the Tokyo session. So you can as well use the previous day to tell the story of what will happen in the present day. So let's say there's a huge move in the New York session. The next day usually will experience a low move, because market tends to range after a huge expansion, because that's when there's profit taking, there's retracement, and all these things. So understanding these sessions, what happened during these sessions, can help you read the market and read the chart and know what action to take. So now, what are the pairs? Like I said before, I just listed them properly here so that you can see. Now, since the Tokyo session is when news from Australia, New Zealand, and Japan comes out, this presents a good opportunity to trade news events. So look at the pairs. We have New Zealand dollar, all dollar, dollar yen, CAD yen, all the yen. So these are the best pairs to trade. Any pair any pair that's paired with any of these countries is best to trade in this time window. Then now we have the London session. Today, London benefits from its time zone. London's money overlaps. And there's also something called overlapping, which was mentioned in the previous slide. That slide showing the table. London has this uniqueness where it overlaps with the Asian session and the New York session. So what does that mean? It means there's huge volatility. You can see here about 43% of all Forex trade happen in London. So London can also be called the European trading session, as written here. So London has huge amount of volatility. London is one of the best times to enter the market, because the London session crosses with the two major trading sessions. And with London being such a key financial center, a large chunk of Forex transactions take place during this time. This leads to high liquidity and potential lower transaction costs, that is, lower PIP spreads. Most trends begin during the London session, and they typically will continue until the beginning of the New York. So most trends begin during the London session, and typically will continue until the beginning of New York. So after the Asian session, especially in the European pairs, the trend begin because this is where there's liquidity. Trend begins during the London session. And then sometimes actually volatility tends to die down in the middle of the session. As traders often go for lunch, as when they're taking their profit, or they are trying to really strategize for the New York trading period. Trends can sometimes reverse at the end of London session, like I said before, as a trader may decide to lock in profits. So now, what are the major pairs to trade? But before I talk about the major pairs, I want to say something. Now you can see that this session has specific characteristics, and it will take you going to the chart to see these characteristics. I'm just pointing them out to just give an overview. As we go deeper in this mentorship, I'm going to be giving strategies and to help you read the market. If you see what happens in the Asian session, it can help you determine what will happen in London, what will happen in New York, and you can also use the previous trading sessions to tell what happened in the present day that you are trading. So sometimes the London session will trend and then retrace, which will give an opportunity for a continuation in the New York session. While sometimes New York session will serve as a reversal. Some of us may not know what reversal is trending. Don't worry. Just get a picture. This is just to let us know that there are specific times that we can trade the currency market, and this is the specific time window. So if we understand this, we can move forward. So this is just the basics. This is an overview. Now, which pairs should you trade? Very simple, the European pairs. European, all the ones that are crossed with the European currencies. So we have the British yen, we have the Euro, USD, British USD, all those pairs that cross with the British GBP, that's the Great Britain pounds, and the European currencies. We have the New York. Some traders also refer to the New York session as the North American session. So some people call it, so it's usually called the New York session. Well, here about 70% of all Forex transactions happen in the New York. There is high liquidity during the morning as it overlaps with the European session. So this is where there's high liquidity. Then during the afternoon period, it begins to die down. Most economic reports are released near the start of the New York session. Remember, about 85% of all trades involve the dollar. So majority of the markets is affected by the dollar, especially the commodities. We have the stocks, we have the S&P 500, we have the NASDAQ. They are usually paired with the dollar. So it affects the market. This session actually is where market actually also traded, because the economic news are also released. Transaction go on within currencies where they exchange currency in order to import goods. There is very little movement Friday afternoon as Asian traders are out. So not all the days you would expect high volatility. Like I said it in one of our lectures, each day of the week has its own characteristic. So there is huge volatility more in Tuesdays, Wednesdays, and Thursdays. But on Friday, there's low liquidity. And we can see that during the New York session, because that's like the end of the session for the day. So we have the Asian, we have the London, and then we have the New York. So this New York session, we see that there is low volatility on Fridays, but sometimes Fridays, you can see huge move. You can see a reversal. And why this happens is because many people are actually taking profits. The Monday, the market begins on Monday. Let's say this is Monday. Market begins to trend. Then this is Tuesday, Thursday, this Wednesday, this Thursday. Then on Friday, they want to take their profit. So happens, you see a huge reversal. So all these sessions, you can use them to tell a story. You compile a lot of different factors to give you an analysis of where the market will actually go. All right, so let's move on. So now, what pairs should you trade during this session? Like I said before, dollar is king. You can trade all pairs. But actually, you see huge volatility when you trade the major pairs and the minor pairs. So all those weird exotic pairs, weird crosses, you should avoid them. But when you see the major pairs, those are the pairs that are paired with the dollar, they actually move well during this session. So an essential terminology I would like to explain to us is swap fee. Swap fee refers to the interest earned or paid for a trading position that is kept open overnight. It is a commission or rollover interest charged by a broker for extending a trader's position overnight. The fee is calculated based on the interest rate differential between the two currencies involved in the trade. If the interest rate of the currency bought is higher than the interest rate of the currency sold, a fee is credited to the account. If the interest rate of the currency sold is higher, a swap fee is charged to the account. And now if you leave a trade beyond past 5 p.m. Eastern Time, what happens is that there's a swap fee that will either be credited to your account or debited from your account by your broker. So it's a fee that you have to pay if the currency you buy has a lower interest rate. So let me give an example. Let's say you purchase Euro USD. And then the interest rate for Euro is 2.0%. And then the interest rate for dollar, 5.0%. So now because if you buy, let's say you buy this pair, now because the interest rate for dollar is higher than the interest rate for Euro, you have to pay a swap fee if you leave that trade overnight. But let's say you are selling this pair. If you are selling, it means what happens? You are selling Euro and buying. So you are buying the one that has the higher interest rates. What happens? Your broker will give you a credit of a swap fee, and swap fee is actually measured in percentage.